Hello and welcome to this video about options, explained for beginners. Options are a type of financial instrument that can be used for hedging or speculation. While they may seem complex at first, they are actually relatively straightforward once you understand the basics. In this video, we will explain what options are, how they work, and some of the key concepts you need to know to start trading them. What are options? An option is a contract between two parties that gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price and time. The underlying asset can be a stock, a commodity, a currency, or even an index. There are two types of options: call options and put options. Call options give the buyer the right to buy the underlying asset at a predetermined price, called the strike price, before the expiration date of the option. Put options give the buyer the right to sell the underlying asset at the strike price before the expiration date of the option. How do options work? Options work by giving the buyer the right, but not the obligation, to buy or sell the underlying asset at the strike price. If the buyer decides to exercise the option, they can buy or sell the underlying asset at the strike price, regardless of the current market price. If the buyer decides not to exercise the option, it will expire worthless. To buy an option, the buyer must pay a premium, which is the price of the option. The premium is determined by several factors, including the price of the underlying asset, the strike price, the time to expiration, and the volatility of the underlying asset. Options trading strategies. There are several options trading strategies that traders use to take advantage of different market conditions. Here are a few of the most common strategies. Buying call options. This strategy involves buying call options to profit from an expected increase in the price of the underlying asset. The buyer pays a premium for the call option, and if the price of the underlying asset rises above the strike price, the buyer can exercise the option and make a profit. Buying put options. This strategy involves buying put options to profit from an expected decrease in the price of the underlying asset. The buyer pays a premium for the put option, and if the price of the underlying asset falls below the strike price, the buyer can exercise the option and make a profit. Selling covered calls. This strategy involves selling call options on a stock that a trader already owns. If the stock price remains below the strike price, the trader keeps the premium from selling the call option. If the stock price rises above the strike price, the trader must sell the stock at the strike price. Buying straddles. This strategy involves buying both a call option and a put option on the same underlying asset with the same expiration date and strike price. This strategy is used when the trader expects a significant price move but is unsure which direction it will go. Risks of options trading. While options trading can be a profitable way to trade, it is also risky. Options trading involves leverage, which means that traders can potentially lose more than their initial investment. Options trading also requires a good understanding of the underlying asset and the factors that influence its price, as well as a good understanding of the options market. In conclusion, options are a type of financial instrument that can be used for hedging or speculation. They give the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price and time. Options trading can be a profitable way to trade, but it also comes with risks. As with any investment, it is important to conduct thorough research and analysis before making any decisions.